Great. Thanks everyone for participating. I'll just get us started. Um, Hi, welcome to Sustainalytics webinar on our new carbon risk rating. My name is Melissa and I'm a member of Sustainalytics marketing team. I'm based in our Toronto office and I have the pleasure of being your moderator today. We're delighted to have so many of you on the call today. And I'd like to extend a special note of welcome to those who are joining us for the first time. For those of you who are unfamiliar with Sustainalytics, who we are and what we do, we are a leading independent ESG and corporate governance research, rating, and analytics firm that supports investors around the world with the development and implementation of responsible investment strategies. So today I'm joined by Vikram Pupala, Associate Director of Product Strategy and Development. Vikram wears many hats within Sustainalytics, one of them being the product manager of our carbon research. In this role, Vikram is responsible for providing our clients with a set of tools and analysis that will help them understand and manage their carbon-related risks. Vikram holds an MBA from the Schulich School of Business, a master's in industrial engineering from the University of Florida, and is a certified project manager. So today, Vikram will be leading the discussion surrounding our new carbon risk rating. His presentation will take approximately 25 to 30 minutes and will be followed by a Q&A session. So overall, the webinar should take no longer than 45 minutes. So before we begin, I'd like to just run through some housekeeping items. You'll notice that you are all currently muted. And you will remain so for the duration of the webinar in order to minimize any background noises or disturbances. We invite you to send any questions that you have through the interactive chat box you see at the bottom of the screen, highlighted with the number 1. Incidentally, if you have any sound issues during the course of the webinar, you can inform us through this question box. Finally, if you'd like to minimize the screen or the interactive panel, you can do so by clicking on the arrows at the top of the screen as indicated with the number 2. Also, if you have any more pressing technical issues, you can dial GoToWebinar at the number on the screen. So just looking at our poll results, it would appear that the majority of our audience is not currently doing any carbon footprinting. And with respect to the whether current carbon footprinting is sufficient for risk analysis, it would appear that most of our audience does not think that is the case. So on that note, I'm going to pass things over to Vikram. Just one final note that the webinar is being recorded and will be sent to our participants in the coming days. So Vikram, if you want to take over control, I'll pass things over to you.
All right, thanks, Melissa. I will share my screen, and Melissa, can you confirm that you're able to see my screen?
Yes, I can see it.
All right, thank you. So thanks everyone for joining our carbon risk rating webinar. Just want to echo the poll results a bit. I think what we've seen the last couple of years is that carbon has grain, measuring carbon risks or impact in your portfolios has gotten traction in the last couple of years, and most of our clients, the past couple of years used carbon footprinting as a measure of understanding, carbon risks to start with, and report on carbon emissions of the portfolio. And I think in the last few years, and especially last year, it's becoming more and more evident that and there's a recognition that the climate change has a material impact on companies, and the coming transition to the low carbon economy has a material impact on companies. Some more than the others, but there's a recognition that there is a material impact on companies, and from the recognition comes the fact that because of holding the holding of these companies in portfolio two will also lead to an investment risk in the portfolios, meaning that having this portfolio, having these companies in a portfolio could result in risk in the portfolio that need to be understood and managed. The task force for climate-related financial disclosures, put out some recommendations in last year, and one of the push has been to understand and manage risks in the portfolios, and I think there's a recognition from them as well that footprinting is a good starting point, but we need to do more to understand portfolio risks with regards to carbon, and we need to build some necessary metrics to have a more holistic understanding of carbon risk. So the focus has become, how does climate change impact or carbon impact companies materially, and how do we manage them? This is an interesting figure that the French CIF, in one of its article in response to the French law 173 published a while ago, and it's an interesting view of looking at footprinting and risk. So if you look at the contribution of the portfolio to the greenhouse gas emissions, in the sense by owning the companies in your portfolio, you are contributing, or you're responsible for contribution of some of those greenhouse gas emissions. So footprinting is a great tool for that, and it's allocating some of the emissions of the companies that you're holding in your portfolio to the portfolio. So its impact of the investments on the world is one way to look at it. But then there are all this transition risks due to regulation, carbon price, supply constraints, consumer preferences, et cetera, that has an impact on the holdings itself. It has a material impact on the companies and their ability to do a business and to grow and become profitable because of all these external factors impacting the companies due to carbon risks. And this is the impact of the world on the investment. So this is a different view. It's how are your investments positioned to manage these external risks due to climate change. So there's it's a different view when you talk about risk versus impact of investments with regards to emissions. So understanding this and the feedback that we've been getting from our clients, saying that carbon footprinting is a great start, but we need more metrics, deeper understanding and understand of risks, has led us to embark on putting together a methodology and a framework that allows us to measure risks in the portfolio due to carbon, and this is what has culminated into our carbon risk rating offering. If you look at the chart here, I mean, if you look at the chart on your right, if you look at our carbon footprinting measurements, and we're looking at scope 1 and scope 2 only here, you look at Exxon and EDF almost having similar carbon intensity. Of course, the big part that's missing is the scope 3 emissions. If you take the life cycle emissions of the oil and gas, obviously that's going to change the carbon intensity of ExxonMobil, but it is seldom reported. It is a tough task to estimate accurately to understand the risks in Exxon, for example. So it is a significant undertaking to fully get a picture of what the risks are in each company, just by looking at carbon emissions and carbon footprinting. So there is a challenge that or a recognition that carbon emissions and intensity is not enough and way too difficult to measure carbon risk. If you look at our analysis, I think something what we were able to think through and come up with a method that allows us to kind of understand the risk. So if you look at on the chart on your left, you can see ExxonMobil is a severe risk through our risk rating, and EDF is low, and the reason is EDF is a utility in Europe, and it has 75% nuclear in its fuel mix, 10% of renewable energy, and about 15% fossil fuels. So if you look at it, the risk actually of carbon or transition to low carbon economy is about impacts 15%. You can argue it impacts only 15% of the overall company valuation, right, or value at risk. Whereas ExxonMobil, 100% of their revenues are related to fossil fuels, and it is at a higher risk because it is, if you move to low carbon economy, there's a recognition that not all of it will be valuable. Fossil fuel will be used much lesser. So ExxonMobil's business at risk is significant, versus CDF, there is only a small, a reasonable percentage is linked to fossil fuels. So that's an interesting assessment. Even though the intensity of these two companies are the same, the risk is different. And if you look at the chart on your left, you also see the color, the dark orange and the light orange. What it signifies is that the dark orange is the risk in its operations, and light orange is the risk in product and services. So we're able to measure and understand risks both in operations and in product and services. When I mean operations, I combine supply chain into that operations as well. So we're looking at operations holistically, and then products as a separate category. What is also interesting is to say that some companies like Air France or ArcelorMittal has all of the risk in their operations, and this is understandable because steel companies or cement companies, for example, all their emissions and the carbon risk is in their own operations, because cement or steel is highly energy intensive, right? And if you transition to low carbon economy, you are under significant pressure to reduce that emissions. However, steel or cement, once it's built or once it's produced, has no emissions on its own. So there's no emissions from cement per se, or no emissions from steel. So the use of the product is not at risk, but the making of the product is at risk. So therefore, the own operations is riskier. Whereas if you look at GM, General Motors, the recognition that the product, which is the car, is at risk because there's a transition to move towards electric vehicles, and the recognition that the internal combustion engines will fade away in sometime in the future, is a huge risk on GM on its product side. It can be doing a lot of things on its own operations. How they build the cars could be much efficient, but the cars itself are more at risk because you need to build a different product. If you compare that to Tesla, the product risk is minimum because the product itself is green and it's not low emitting vehicle, whereas most of its risk is in operations because they're not as efficient as GM. So it's an interesting nuance of where the risk is. It's different for different companies. It's in products and it's services, products and services, or it's in operations. But you can measure risk in a meaningful way. For example, Citigroup, for banks, all the risk is in their portfolios or the lending book, because they're lending to fossil fuel companies, coal companies, etc. So if they are at risk, if they default because they can't transition, it's a big risk on banks. So all the risk, carbon risk, is in the products and services. In this case, we are measuring in their loan book and their investments, whereas not material risk in their own operations, in the sense that it doesn't matter if Citigroup or any other bank is in a green building or not. It's not a material impact on the company. Yes, it helps from a impact point of view, but it's not a big factor in its materially impacting the company. So understanding where the risk is and then how companies are managing that risk is the basis of our risk rating. So our approach to assessing risk. So what we measure is the degree to which a company value is at risk, driven by the transition to low carbon economy. Again, it's in relation to the materiality or material impact on companies. The way we do it is we want to look at the exposure to carbon risks and the management of carbon risks that are material to company. That's the the two pillars we want to look at: exposure and management. We also look at own operations and product and services. So we look at exposure and management of carbon risk in own operations, exposure and management of carbon risk in product and services. So we look at in two dimensions, but we also look at, and we're also looking at risks and opportunities. By opportunities, I mean solutions, low carbon solutions like, renewable energy, green transportation, green buildings, et cetera. So if companies are deriving revenues in those areas, they are definitely well positioned to transition. They're at a lower risk, and that is an assessment of their risks and how they need to manage the risk. So it's including risks and opportunities is also an interesting a view that we built into our analysis. So the building blocks of our carbon risk rating is this four elements. I mean they are the same for both operations and product and services, but essentially we start off with a sub-industry exposure score. So we look at exposure of each sub-industries, and we have about 142 or so sub-industries. So we start off with understanding exposures of different sub-industries to carbon risk, and then we look at companies within each sub-industries and say how the companies are exposed differently within a sub-industry to these carbon risks. And then we assess companies' management to these carbon risks. How are companies managing it? And different companies within the sub-industry is managing it differently. And then we end up with unmanaged risk. So the unmanaged risk part is essentially our carbon risk rating. Carbon risk rating is unmanaged risk of each company. Unmanaged carbon risk for each company. So it's a top-down approach in assessing carbon risks, unmanaged carbon risks, and we do this for both operations and product and services. So as I said, we start with our assessment of sub-industry exposure to carbon risk, and we recognize that not all industries are equally exposed to carbon risk. Obviously, this is very intuitive. Oil and gas companies are more exposed than, let's say, healthcare companies or IT companies, right? So we want to recognize different industries' exposure to carbon risk and quantify them in a way that's relative to each other. So oil and gas, if you look at the bars itself, orange bar is own operations and blue is product and services. So there is when you combine those two, there is more risk in oil and gas industry, sub-industry versus, let's say, real estate industry relative to oil and gas. So it's a relative analysis of each sub-industries with respect to carbon risk, and we do it for both operations and product and services. Interesting to note is that if you look at automobiles, the blue bar is similar to the blue bar in oil and gas, in the sense that the risk in product and services in automotive industry is similar to the risk of oil and gas industries, and it's similar, but if you look at own operations, automobile is much lower than oil and gas as well. So it also allows us to separate where the risk is and understand in relation to each other what the risks are. So again, steel and packaged food, all the risk is in their own operations. There is no risk in the products. Real estate, all the risk is in their products, which is their green buildings or the buildings and the management of those buildings. But if you look at relative to oil and gas or automotive, it's relatively low. So you can say 1/4 of the risk of real estate in products is equal to the risk in automobiles is 2 and 8, right? So you can relatively look across sub-industries and also assess risk. So that's a starting point of our analysis, the sub-industry exposure scores. From there, we look into companies' exposure to carbon risk. So the starting point for company analysis is that all companies within a sub-industry inherit or retain the exposure for that sub-industry. So all real estate companies, in the previous example, as I said, all real estate companies starts off with the risk of 2 in the product company, whereas all automobiles start off with the risk of 8 for product and services. So all companies inherit the sub-industry exposure score. And then once we have that, then we adjust the companies up or down or high or low exposure based on some industry specific metrics. Let's take an example for automotive industry, and let's say, for example's sake, let's say the automotive companies are at 5. So all the automotive companies starts off with 5. So the gray bars in the middle of the chart is starting point for all automotive companies. But then we look at fleet emissions as a metric. Fleet emissions is reported by almost all automotive companies to EPA in the US and EU, and it's a relevant metrics for automotive industry. So we look at fleet emissions and find that GM and Ford have one of the highest fleet emissions because they have a lot of SUVs and trucks in their fleet, and the fleet emissions are higher. That's reported to EPA. So we say that these companies have higher than average industry exposure to carbon risk because any regulation will impact their will be targeted to reducing the fleet emissions. Given that they have higher fleet emissions, they're at higher risk. So we move the exposure score to the right, maybe increase the exposure of GM and Ford. In this case, let's say example of Ford, and we multiply by a factor of 1.5, and you move it from 5 to 7.5. So the furthermost orange dot on the graph on the right is Ford. So you can see Ford has an exposure of 7.5 because it's above average fleet emissions. On the other side, Tesla, for example, has no fleet emissions because it's all electric. So you reduce the risk of Tesla from 5 to 2. So you multiply by 0.4 and you move the Tesla to your left. So from 5 it goes to 2. So what it allows us to do is separate out the companies within the sub-industry from with a starting point of the average, and you separate out by moving up to low or high. So Tesla with the 4, Tesla with a risk of 2, and GM with the risk of, or 4 with the risk of 7.5, and every other company in the middle are moved as per their fleet emission metric. So you have an industry-specific separation as well within the companies in the carbon risk. What is interesting to note is that the risk is absolute in the sense that a 7.5 exposure in automotive could equal to a 7.4 exposure in an oil and gas, equals to 7.5 exposure in an industrial company. So the 7.5 is equal across all industries. So by moving GM or Ford to the right, you are essentially bringing its risk equal to some other riskier companies, let's say oil and gas companies, et cetera, et cetera. So it is also comparable to other industries when you when we make these adjustments. Once we have that, we then once we have exposure score for each company, then we look at how the companies are managing this exposure. So in a simplistic way, you have exposure score of, let's say for GM in the example, 7.5, or let's say an oil and gas company, let's say if exposure is, let's say 9, and you have a management score. We score companies based on their management. We look at the management score. We look at their greenhouse gas reduction programs, greenhouse gas management, environmental policies, and all those indicators, and we assess companies on how they're managing this risk, and then we score companies on those indicators. And once you get a score, it is interpreted as a percentage. So if a company gets a score of 80, it's assumed as 80% of the risk is being managed. So if your company starts off with an exposure score of 9 and 80% of that risk is managed, so we're saying 80% of 9 is, let's say 7.2. 7.2 is managed. Of the 9 points of risk, 7.2 points are managed, and the 1.8 is unmanaged. So unmanaged risk is the risk rating. So if you look at the chart here, on the right, if you see the unmanaged risk, the one that's highlighted in the red box, so that's unmanaged risk. Unmanaged risk simply is exposure managed risk exposure minus managed risk in a simplistic way. What we realized is that for some industries, not all exposure can be managed by the companies, no matter how best policies and practices and targets they have. The inherent nature of the industry and some of the systemic risk doesn't allow them to manage the full exposure. For example, coal. Coal as a product, when we extract coal, when a coal company extracts coal, the emissions from coal when it's being used cannot be managed by the coal company. In the sense that if you burn coal, you are bound to emit greenhouse gas emissions. No matter what the management does, it cannot stop the emissions from coal. So there is very little manageability of emissions from coal. So even though whatever the management can do, it only impacts a small part of the risks. So we introduce a factor called manageable and unmanageable risk. So that's the second bar in the chart that you see here. So we say for all coal companies, the manageable risk is only 50% or 20%. So basically, 80% of the risk cannot be managed by coal companies. Whatever the management policies, practice they have, it's only goes to reduce the risk by 20% only. So we add that factor there. So if you put it all together, you have exposure, then you have manageable risks, the light blue bar, and of the manageable risk, how are companies managing it, and whatever is left is unmanaged risks. The dark green part is unmanaged risk. How it has all come together. So if you look at from right to left, so let's take a company here. So exposure, you start off, you have an exposure of 2. After you make the adjustments from sub-industry, the beta adjustments, you get an exposure score of 2. And then of the two points of risks, 1 point is managed, so 50% is managed and 50% is unmanaged by the company on the product side. If you look at on the own operation side, the exposure is 13. Only 2 points are managed and 11 points are unmanaged by the company. So when you put it all together, you can simply add up because these are absolute numbers. You can simply add them up. So if you look on the left, you have the total exposure of 15, which is 13 in the operations and 12 in the product and services. Similarly, you have managed risk of 3 because it's 2 under operations and managed risk of 1 in the products. So you can combine them. It's a managed risk of 3, and then then unmanaged risk of 12. So you've got exposure of 15, you're managing 3, your unmanaged risk is 12. So that's the risk rating. So 12 is the risk rating, and what does it mean in the context of the whole universe? So we assign a risk category for the score. So anything 0 has negligible risk. Anything 0 to 10 has low risk. 10 to 30 is medium. 30 to 50 is high, and greater than 50 is severe. So if you look on the meter image on the left, that tells you the risk of this company, which is 12, which is medium risk in relation to the other. So any company that's got 50 or more has significant unmanaged risk that is unlikely. It's going to impact significantly the company's ability to transition. So that's the final risk rating. It's the unmanaged risks of companies. Quick example, if you take GM and Ford, GM and Tesla here. So if you look at the columns here, you've got own operations and product and services. So the exposure for own operations is driven by carbon intensity metric. That's the indicator we use, and based on that, the exposure for GM is 15 points. On the product and services, we look at fleet emissions, and GM has significant higher fleet emissions. So the risk, the exposure to carbon risk is 35 points. So the total exposure, the second row, if you look at it, the total exposure is 50. So 15 plus 35 is 50. So we've got 15 points of risk in operations and 35 in products. And how is GM managing it? So GM is managing 9 points of those risks on own operations, and it's managing 6 points of this risk in the product and services. So so when you add them together, you have 15 points of risk that's being managed. So of the 50, total 50, GM is managing 15, which means unmanaged risk is 35. We can also look at unmanaged risk of its own operation. So it's got 15 exposure, managed is 9, unmanaged is 6. Similarly on the fleet emissions. So that gives us the score for GM. And if you look at Tesla, chart there. So Tesla's own operations exposure is 13, right? Carbon intensity is comparable to GM, but however the fleet emissions is significantly low because it's not emitting vehicles. So the exposure is 2. So compared to GM, exposure is 35, and Tesla's is 2. So that itself shows that they're less exposed because of their current products. So the total risk for Tesla, total exposure for Tesla is 15. Then how is Tesla managing it? So on their own operations, Tesla is only managing 2 points of risk, and compare that with GM. GM is managing 9 points of risk. So from a management of risk point of view, GM is better in its own operations than Tesla, right? Tesla is only managing 2 points, and this is based on the indicators that you see: greenhouse gas reduction programs, etc., etc. On the product side, Tesla is only managing 1 point of risk. However, it's at low. The starting point of risk is 2, right? It's already at low risk in its own product and services. So overall risk is not significant on the product and services. But when you all put it together, Tesla starts with 15 points of risk. It's only managing 3 points. It's unmanaged risk of 12. So compared to GM, Tesla is significantly lower risk. But if you look at own operations for Tesla and GM own operations is less riskier than Tesla's own operations. So unmanaged risk in own operations is 6. Unmanaged risk in own operation for Tesla is 11. So Tesla is more risky in its own operations than GM. However, GM's products are more risky than Tesla's products. Therefore, overall, GM is more riskier. So how do we, I mean, as an example, we provided some of the indicators that we look at. So some of the exposure indicators we look at, carbon intensity, if it's an own operations. We look at standard carbon asset risks. This is applicable to oil and gas companies. So oil and gas companies that have more standard asset exposure will have higher risks than companies that have less standard asset exposure. So that we can differentiate oil and gas company based on standard asset risk there. We also include negative product involvement in the sense that we look at fossil fuels. So if you're dependent on fossil fuels as a company, you're more riskier than a company that's less dependent on fossil fuels. So let's say if your utility, 50% of your fuel or 50% of your revenues are derived from fossil fuel power plants or like coal power, thermal power plants, then you are more riskier than a utility that is only 10% of power plants based on coal or gas. So you can separate out companies based on their fossil fuel involvement. The more fossil fuel involvement, the more risk you are. Similarly, we look at positive products and services in the sense that if you have renewable energy, if you're producing renewable energy, or if you have green transportation in the case of Tesla, or if you have green buildings or energy efficient products, so you are providing solutions for a low carbon economy, so your risk is decreased. So a company that has some renewable energy assets, some revenue derived from renewable energy would have lower risk than a company that doesn't have any revenues from renewable energy, as an example. So you're reducing the risk because they are well positioned to transition due to this carbon solutions. Similarly, in the products, we look at different metrics. For banks, for example, we look at responsible asset management. Not just banks, but for financial industry, we look at responsible asset management as an indicator to see whether you have programs and practices that allow you to invest in some of these solutions and non-negative involved companies. And then on the management indicators, you can see all the management indicators that are that we use to assess companies. These are just a subset of it. We have more than these, but just an example. And if you look at now the final risk rating is this is across the economy. This is the whole universe that we cover, about 4,000 plus companies. You can see that on the left, you can see oil and gas companies. that are distributed from top to bottom. So the worst performing oil and gas company gets a score of 80. The best performing oil and gas gets a score of 30 or so. I think it's Total that gets a score 30. But what is interesting is that you can compare that 30 across all industries. So GM gets a score of, I think, 35 or so. What it tells you is that GM is more riskier than Total. Even though intuitively we say all oil and gas are more riskier, but because they're managing it, they're transitioning the plants. From a portfolio point of view, GM, from a company point of view, GM is more riskier than Total, which is, and you can use this compare across industries. So a score of 30 is much better than a score of 50. So it doesn't matter which sub-industry the company belongs. If you get a higher score, you're more riskier. So you can look at across industries and compare across industries different companies. So this is the distribution, the final distribution that we get when we do the risk rating. Finally, how is our product offered? We offer through data services. So basically, you can get this in the form of a data. You've got the carbon risk, all the carbon risk data points. But in addition to that, we are also providing carbon intensity and carbon emission metrics. We're also providing fossil fuel involvement, green and carbon solutions involvement, standard asset risk. So we're providing all the important signals that you see in the market that is being used. So we are providing, in addition to the carbon risk rating, all these additional signals are built into the carbon risk rating. And there's more than these signals. There are multiple data points that are built into carbon risk rating that's used in the assessment. But these are some of the data points that are widely used in the market. So I think we wanted to provide that. So we want to give as much information as possible for our clients to then do their own analysis on top of the risk metrics that we provide. So if you just want to focus on fossil fuel involvement and do some screening, you're welcome to do so because we have the data points available for them. But the carbon risk rating is our headline metric that we are providing along with all the other data points. And then if you look at carbon portfolio analytics, so carbon risk analysis. So this is a portfolio level view of carbon risk. So we roll up the holding carbon risk of each holding, weighted carbon risk of each holding to the portfolio level and compare to a benchmark. So low risk or high risk, and then where does a benchmark fall? So you can compare with the benchmark. In addition, you can also do attribution analysis of carbon risk. Whether it's stock selection or sector allocation. You can look at the top 10 contributors to your carbon risk, etc. So more detailed analysis using the carbon risk metric as a headline metric. In addition to that, we're also providing analysis of carbon intensity. So if we look at we're providing both carbon intensity to the portfolio vis-a-vis the benchmark. We're providing fossil fuel involvement to the portfolio vis-a-vis the benchmark, standard asset risk, and solutions involvement as well. So there is this additional information that is also available for our clients to look at a portfolio level in addition to the carbon risk rating. Carbon risk rating is the headline metric, but there is also other data points that we are doing this analysis that is useful in the analysis, or that's used in the market today as well. So with that, I come to the end of the presentation. I recognize there's a lot of information here, and happy to take any questions from the audience.
Great. Thank you so much, Vikram. That was a really detailed, informative presentation. So we do have a couple of questions here. The first one being, what about the risk of carbon in financial industries supply chain? 90% of carbon emissions are said to be in the supply chain.
For financial?
I think so. Financial institutions.
Or FI?
Yes.
Does it say FI? Okay, I fixed it. So I think one of the things is we looked at supply chain risks across industries, and we found that only few industries have a material impact. When you say material, it significantly decreases the value at risk, right? So if does the supply chain risk impact the company's value at risk. And we find only few sub-industries that supply chain is meaningful. And even then, it's relative to its own operations and related to the product and services, it is pretty low. So we're getting a 2 points or 3 points of risk. When I say 2 points of risk, 2 points of risk impacting the company itself in terms of its valuation, in terms of its ability to transition. One thing to note is that we also assess the companies that are supplier to some of these companies. For example, Magna is a supplier, or Johnson Controls is a supplier for automotive industry. So we also assess them separately, and they would get a higher risk because of their own operations and their risk in their operations. But it doesn't. The risk of Johnson Controls, for example, is not significantly material to GM or Ford per se. It is material, but not significantly material. So we actually combined the supply chain into own operations when we're doing an analysis, and increases a little bit of risk for GM and Ford, but we assess them separately. So at a portfolio level, you're not double counting per se. If you have Johnson Controls and GM, you're not double counting it, but we combine them in own operations. And we see it's only material for few industries and very little.
Right, okay. And then I think this is a related question, again, asking about the financial industry. Does the carbon risk rating methodology take into account indirect carbon exposure of financial industry, including insurance? That is the exposure through loan programs, underwriting, asset management activities, etc.
Right, that's exactly it. That's what we try to. That's the exposure. I'll leave the slide somewhere. But that's exactly what we're trying to do is, looking at metrics that allow us to measure the book, the loan book or the lending book of companies. And if you look at here, Citigroup in this chart, you can see that all the risk is in the product and services. What we mean by products and services is that indirect exposure through their loan book. So that's exactly what we're trying to measure. Yes, the answer is.
Great. And is there any consideration of emerging technologies for carbon capture and sequestration factored into the risk?
Very good question. So, not at this point. We recognize that that's absolutely needed for us to really reduce our emissions if you want to be in a less than 2-degree world. Unfortunately, there are not much technologies and not much revenues derived from those technologies by most of the companies. So there is no material impact of these technologies on the companies yet. As the companies started, some of the companies started producing this and scaling this technology, and they start getting some revenues from there, we can say these companies are better positioned to transition to low carbon economy. They're offering solution, but as of yet, they are not. There's no company that's getting reasonable amount of revenues from these technologies.
Okay. So we have someone asking, how do you quantify the risk into a number? So I think this is going back to the breakdown of the score.
Sure. So for a sub-industry, we actually looked at, and again, there's a lot of information that allows us to look at industry by industry, what is the risk. So there's IPCC reports. There are so many reports that obviously tell us which contribution of greenhouse gases by different industries. We also look at companies' own materiality assessment. So when you look at their sustainability report, companies say, these are our material risk, and we looked at that. Then we also looked at carbon intensity data for each industry to assess the risk and carbon intensity data. And finally, we had our analysts for each sector analyst and go over all of this information and provide a score on a scale of 0 to 10 for own operations and for product and services. So if you look at the slide here, that's where the starting. So oil and gas, looking at all those information, a score of 10, which is the highest risk for oil and gas, is been determined, and then we go down for each industry, and then we determine similarly using all these data points and all this information, industry by industry, and then we determine on a scale of 0 to 10 for each industry. Once the industry score is established, then we use industry-specific metrics, as I mentioned, to adjust that risk for each company. So we look at fleet emissions and then adjust the industry's risk up or down. So it's a data-driven analysis once it comes to a company level assessment as well.
Okay, thanks for explaining that. So we have one more question here. Why is the carbon risk rating for the oil equipment industry so low, since they fully depend on the oil and gas industry? So I think this goes back to the distribution slide that has all the industries across it.
Right, and I think this is a good question. I think it is not low. It is. I think it's a medium risk category.
Mm-hmm.
I think there is a recognition that, and we can argue either way, but I think there's recognition that some of these are diversified, and of course there are some companies that are highly reliant on oil and gas industries, and then definitely more riskier. But some are also a bit diversified, and some of these can be transitioned to like other drilling activities, or transition to, they can some of these available to a mining company, some of the services. So there is some flexibility in those industries to transition. Again, some are more flexible than the others, absolutely. And there's something that we are looking into and seeing if there is some other metric that we need to look into and adjust this a bit. We recognize it's a little bit on the lower side, but I think the rationale is that some of them are better, can in a way diversify some of those products into other industries.
Right. Okay. I think that makes sense. So I don't see any other questions listed here. So I think we'll wrap up. Thanks again, Vikram, for sharing with us the new carbon risk rating. Just a reminder to our audience that the webinar has been recorded, and a recording, the link and the slides will be shared with you in the next few days. Feel free to contact us or reach out to Vikram if you have any additional questions that you didn't get to ask today. And I thank everyone for joining, and enjoy the rest of your day.
Thank you, Melissa.